Yeah, so guys, so in this video we shall be talking about the daily bias. So the daily bias basically anticipate the direction or movement of the market, and it is determined by analyzing the market from a higher time frame to a lower time frame to identify the trend of that day. So basically the daily bias works like this. So if the candlestick closes below the previous candlestick, it means a continuation. Like if a candlestick closes below or above the previous daily candle, it means the continuation of the market. And if the candlestick sweeps the liquidity or sweeps the low of the previous candlestick, it means that is a reversal of the market. So example I've said, so if the candlestick sweeps the low or the high of the previous candlestick, that's a reversal. And if the market or if the candlestick sweeps or closes above or below a previous candlestick, that is a continuation. So let me use an example. So this is GBPJPY on a daily time frame. So you can see this is a candlestick. So this is on Wednesday, this one. So this is on a Wednesday. So the market closed above the previous candlestick. So this is the market. This candlestick closed above this previous candlestick, and it means this is a continuation. I read together. So we had this candlestick, this one. Let me just mark it. So we had this candlestick. So we had this candlestick on a daily time frame, and we had this, the next candlestick. So the previous candlestick, this one, closed above. Yeah, so this candlestick closed the week of this previous candlestick closed above or in between the current candlestick. So that means is a continuation. So let me just use another example so that you can understand. So this is Euro USD. Let me show you the live trade that I took yesterday using the daily bias. So this is Euro USD. So this is Euro USD. So we had this candlestick, this one, this candlestick, the bearish one. So, and you can see it closed below this candlestick. Let me show you. So this candlestick, this one, you can see this week closed below this candlestick. So that means this is a continuation. So after identifying the daily bias, the market, the direction market of that day, so you scale down to a lower time frame to identify now, to look for your entry, So on the 1 hour time frame, we had a break of structure. On the 15-minute time frame, we had this break of structure. Let me just show you well. So we had a break of structure here, and we had another block at that particular zone. So that was our entry. Now the next thing is about the target. So after identify the daily bias and looking for the entries, what am I saying? So the target, you are supposed to target the previous daily low or high. So you can see this was our order block. So now let's go back to the daily time frame. So on the daily time frame, just expand it so you can see it clearly. So on the daily time frame, so this week, this the previous candlestick that this candlestick closed in between it was supposed to be the target. So this low, so that this low, just use it well. So this low, this one, was supposed to be our target. So the low of this candlestick was supposed to be the target. So let's go back to the 15-minute time frame. Yes, so this is the low. So that was supposed to be the target, and you can see the take profit was hit. So let me just use another example. On GBP USD. So I've said, let me show you another. So I've said you have a candlestick, and you have a candlestick like that, and we have another candlestick. So we have those two candlesticks. So this has a wick, and this one has a wick too. So I've said if the candle closes below or above the previous candlestick, that is a continuation. So we have this previous candlestick, this one. So the current candlestick, so you can see the market closed above this, or in between this candlestick, so that is a continuation. So we are expecting to have some retest in the market to continue. So if it is, so that is a bullish. So if it was bearish, you can still have the same candlestick. So in this previous candlestick crosses between the current one, so that is a continuation. So if it is a reversal, so you have this candlestick, have that candlestick, and have another one. So this is the low of the previous candlestick, and this candlestick, so now the current one grabs the liquidity of the previous candlestick low and closes inside. So that is a reversal. So we expect, so the market was bearish, so we expect the market now to be bullish. So now mostly at this point, so this is where normally CRT formation occurs. So let's look at another example, a live example now. So we have this candlestick, this one. So we have this, so this was on a Friday. So this candlestick was formed on Friday. This one, that one was formed on Friday. So you can see, you mark the high and the low of it. mark the high, so that's the high, and this is the low, and this is the low. So as you can see, it closed between these candlesticks, so that means the market was still bearish, so that is a continuation. So now then you mark this low of that candlestick, that the previous candlestick closed in between it and the high. After marking the low and the high, so now you will be trading this candlestick since it is a continuation. So now you scroll down to the 1 hour time frame. Now on the 1 hour time frame, we have this order block that is very clear. That order block where you are supposed to place your entry, stop loss above it, and now the take profit, I've said you target the previous candlestick low or high. So this is the previous candlestick low that is supposed to be our target. That is supposed to be our target. Now in some cases you can find a candlestick, a daily candlestick like that one, with a low and a high, and the next candlestick, so this is the high or low. So you expect the market to either close in between it or grab the liquidity and close with a wick. But when you are analyzing your market, you find the next candlestick that was formed looks like this. So it's simply a doji. So when you find the next candlestick looks like this, it's always recommended not to take that trade. So you wait either for the next candlestick, to either close below or grabs the liquidity. So you wait for the next candlestick to either close above it to look for buys, or you wait for the next candlestick to grab liquidity. So that's a reversal. So you'll be looking for sales. Let's look for a clear example. So still on a daily time frame, so you hand this candlestick here. This candlestick, that candlestick. So this is a bullish candlestick. So the next candlestick, this one, came and grabbed the liquidity of the previous D high. So this candlestick, so the next candlestick grabbed the liquidity, this one, and closed inside the previous day low, D high. So that is a reversal. As you can see, it formed a CRT formation. So this is the CRT formation, and as I have said, the target, you are supposed to target the previous day low, this one. So that was the target. Now I've just shown you the market which you are supposed to avoid. So we had this candlestick here. We had that candlestick. This one. It's still a bullish candlestick. We had its high. And we mark its low. So this is the daily bias. We mark it, the low of that candlesticks. So now, the next candlestick did not took the low or the high, and still it didn't close above or below the previous candlestick. So this this market is a consolidation. So when you scale down to a lower time frame, so this is a consolidation. So but the next candlestick took out this high, and the market changed the direction. So it grabs the liquidity. That's a reversal. So I'll make another video to show you how to execute the trade using the daily bias.